afterwards. So welcome. The topic here is insurance, and in the context of sort of risk management for cyber. And, the thing we do for a living in enterprise security is manage risk. That's what you do. And for the longest time, really the only option you had was either make the risk go up or down. You make it go up if you do something dumb, so if there's a vulnerability, or you make the risk go down if you buy some tool or you impose some policy or you do something clever to reduce the likelihood that there may be some sort of problem. So it was always the two options you had. More recently, and when I say recently, I mean in the last 10 years or so, but much more intense in the last maybe 1 to 2 years, we've had this option of also potentially transferring risk. So that's where you shovel some risk up and you hand it over to an insurance company through a whole tangle of infrastructure, and that becomes another option. The problem is most of the people that sort of run in the cybersecurity orbit, and I'll bet a lot of the people who are on this webinar are listening, kind of grew up in that first category where you could easily tell me how a next-generation firewall might reduce your risk. Well, once you start talking premiums and agents and deductibles, well, maybe you have a little experience in your personal life with that, but probably not a lot of experience in business. And you may even, in fact, you probably even are buying policies through a financial or insurance group in your company that takes care of the details. You're just asked to participate, weigh in, and understand and be part of the process. And that presumably is why you're here today, to learn a little bit more about the basics. I know for me, I felt like a total dummy the first few times I started getting involved in underwriting during my career, as a buyer and now as a coach and consultant and advisor looking on a policy. I just felt sort of dumb because I didn't know some of the basics. You're going to get some of that today. Two of my friends here, Anthony Dagostino from Willis Towers Watson, knows as much about this topic as anybody I know. We're going to ask them questions that I'm always too embarrassed to ask, so I can play dummy and ask them, and maybe they'll fill in some of the gaps for some of you. And then Ken Pfeil, who knows as much about risk as anybody I know. He's over at Tech Democracy. He's their CTO. And Tech Democracy has been kind enough to host and sponsor this content. So we're very appreciative to the team to support, and also to Anthony and Ken to be part of our discussion. I'm going to be introducing Ken in a few minutes, but I want to start with Anthony. Anthony, first of all, welcome to the discussion.
Yeah, thanks for having me, and Ken. Really looking forward to this.
Very glad you could make it. Now, Anthony, I want to ask you to play total dummy here, and just when somebody asks you, what are like the real 101 sort of basics of cyber insurance? Can you just take a couple minutes and give us a tutorial? This will be a review for some, but I'm sure there's at least a portion of the folks listening who may not really know, and I think it'd be a good way to get started to just make sure we level set on some of the basic concepts. How does it all work?
Sure. Yeah, sure, happy to. And I would state the old cliche that there are no stupid questions. I mean, the cyber insurance, like you said, it's probably, a decade that it's been evolving, and in step with that is the evolution of technology. So the cyber insurance world in step with the security and risk world is constantly changing. So I think any question is fair game. Hopefully I can live up to your expectations in providing us good answers. But I think the way that you laid it out of just saying, just to underscore, the risks go up and the risks can go down, I think that's spot on, because sometimes there's a belief of we need risk eradication. Let's put everything in place that will make this go away. And we all know that that's not true. It's not risk eradication, it's risk management. And cyber insurance has evolved over the past 10 years. I'll start by saying it does work. At Willis Towers Watson last year, we saw about 470 cyber incidents. So those are the actual claims that were paid by the 100 plus insurance companies we work with. We work between the policyholder and the insurance company. And for full disclosure, my background, I've not only been a cyber insurance broker and consultant, but also have done most of my career underwriting, so I can speak to both sides. But a lot of claims are paid, and I think it's worth noting for those of you that are on the phone, you usually see in the press the times when the cyber or when the insurance policy does not work. It's the court cases, it's the lawsuits. Mondelez is going on right now in the news as we speak. And really there's some misconceptions because those typically are not cyber insurance policies. They're a traditional property policy or another non-cyber insurance policy where a company may be looking for some recoupment. So I think this is an important topic to talk about so we can start to really clearly delineate what's cyber insurance, what isn't. Is it right for you or is it not right? So to answer your question, Ed, I guess the 101 basics, I'll provide two areas. Number one is the coverage. And then number two is typically why we see organizations buying. If you think about the cyber insurance coverage, it tends, and just oversimplifying it, it falls into three buckets of money that the insurance can cover. Number one are your response costs or crisis management costs. Something goes wrong, you have a bad day, and the policy's responding to pay for forensics and the legal fees if you're getting outside counsel and notification and credit monitoring, ransomware payments, which we can talk about later if needed. So that's one bucket, that response. The second bucket is liability. So the bad day happens, all of a sudden, whether it's a regulator or there's a class action suit for failing to disclose or not disclosing in the right way or people just seeking damages, the policy will pay for that money rising out of the liability associated with the incident that took place. The third bucket, which I don't think gets talked about a lot, but really we see as the most important aspect of coverage, or one of the most, is the business interruption coverage. System goes down due to a malicious event. Sometimes it can also be due to a software failure or misconfiguration. And if your network is down and your organization is losing net income because of that system outage, the insurance coverage can pay for that. So those are the three main ones, the response cost, the liability cost, and then that net income loss for business interruption once your system goes down.
That's a very helpful taxonomy. That's good. Hey, Ken, I want to ask a quick question based on what we're discussing here. Ken, you deal with customers every single day focused on risk. What's been your experience about people kind of having a general understanding of cyber insurance? Do you find that in general people have a pretty good understanding, or is that still a bit of a challenge for a lot of your customers at Tech Democracy?
I think, for a lot of our customers, it has been, as Anthony had alluded to, I mean, it's been a continual challenge. And I think it's going to continue to be a continual challenge because, just the rate of risk is changing. And, if you're stuck in this continual loop of kind of evaluating things as they were, 6 months ago, you're not going to be, truly reflective of what your current risk is. And, from the, the three-tower perspective that Anthony spoke to before, understanding what your current risk is critical. I'm speaking as, I'm a former CISO. I was a CISO for about 17 years before, coming over to Tech Democracy to work this platform and to kind of, help make it what it is today. But, and the reason that we did that was exactly that. Folks did not have a view of continual risk. They had, snapshots and points in time and things like that. So I think that is definitely one of, the higher challenges that we run into as an industry. And if you look at, the role of cyber insurance, traditionally within information security and within, businesses themselves, it's gotten a little bit more mature over the years. As things tend to do, but it's still relatively new in relation to other areas of risk that we're all familiar with, especially business risk. And businesses just don't traditionally understand cyber risk as opposed to how they understand business risk.
This may be a little bit jaded based on my own experience, but one thing I see often is that organizations may or may not have a good understanding of their risk, but some board member or some senior executive reads an article and says, hey, we should have an insurance policy, brings it up at a meeting, everybody decides it's a good idea. And I'm wondering, I'll start with you, Ken. Do you ever see that phenomenon where, yeah, maybe it is a great idea, but my observation is that connecting the dots between accurate risk, understanding, and making these decisions seems like a lot of companies are still a ways from that. Haven't really done that and might be making these decisions more ad hoc based on some manager, like I said, reading an article. Does that resonate at all?
Yeah, and my experience in reporting to boards over the years is that, one, they want accuracy. One of the first questions that you're going to get asked by the board is, what is my risk profile, and are we, I can't count the number of times I've even been stopped in the men's room by a board member and said, hey, are we secure today? Well, that's not an easy question to answer. Well, we're secure within budget. We're secure within reason, and we're secure in relation to how we gauge our risk in relation to our top competitors. But just answering those questions is it gets tougher and tougher every day as we introduce new value lines in business and things like that.
Maybe we need to start inventing risk dashboards that go on the wall of the bathroom, right? That would probably be a pretty good product. To think about that. Hey, Anthony.
Yeah, we're starting installing monitors in there.
Right. That's all we need. Anthony, when somebody's looking at a policy, and you've got a lot of experience with this, so what are you looking for in a good versus bad cyber insurance policy? Give us a little 101 on some tips and ideas on what we should be looking for.
Yeah, I think this is an important area because it gets back to your comment about the board. Somebody reads something, they start asking questions. A lot of times we're in that awkward high school dance where it's about to kick off, and it's the CISO and the CRO or risk manager or operational risk people sometimes meeting for the first time and trying to figure out how they should approach it. And it really is, as has been said in the past few minutes, it really is matching up the insurance policy to the operational risks of the organization. It's not just buying something quickly and throwing it in place. It's looking at it like any other risk in the organization. What are you doing around property? Where, if you have factories, where are your locations? Are they fire prone? What protections do you have? Really thinking about your risk tolerance. What can you absorb on the balance sheet? And then are you buying this as the just in case for a bad day, or are you really going to use this for more of help with incident response, which we can talk about? I'd say that the two things, and looking for a good policy versus maybe a not so good policy or a bad policy, is, I guess more generally, don't assume the coverage is elsewhere. That's where we usually see it go south. You might not buy because you see you have an endorsement to a property policy, or your kidnap and ransom policy has some extortion coverage, and you're just assuming that you have cyber coverage. So you really got to read the policies you have, and if you're buying cyber insurance, what that entails. But that second point, what I just said, is reading your policy, understanding your policy. Do you have the coverage? There's three buckets. Does it match up to the critical operations of your organization? If you had a bad day, will your policy respond? I think those are the two biggest issues.
So what about just in terms of numbers? Let me go through a couple of absurd cases, and then we can determine where the meaningful midpoint would be. So, for example, if I was looking at a policy where the premium was $5 million a year and the payout is $10 million a year, the total cap on all coverage, I would say that's ridiculous. I would never buy that. I'd self-insure. But if I was paying $5 million a year, I'm a big company, and it's sort of an unlimited payout with no cap. I know there's no such thing, but if there was, I'd buy that in a minute. So where do you figure out, are there payback periods that you do? I know insurance experts know how to do those calculations. This community is very technical, so I would imagine a lot of people would want to sit down with an online calculator or a tool or something to give them a feel for what the right deductible should be, what the right coverage should be, the right premiums be. And I know that there are insurance groups that do this, but we are inherently geeks, all of us. And I know a lot of people have asked me that. They say, hey, here's this policy I've got. What do you think? Is this any good? I never know what to say. I would say I don't know. What do you say when you're looking at those numbers?
Yeah, I think this is the common conversation. Is it worth buying? Sometimes, depending on your industry and your security posture, it can greatly differ. I would say the data is better because of all the cyber insurance claims. The data is getting better on probability, doing what they call a comprehensive cost of risk analysis. If I'm in a certain industry and certain jurisdictions and have a certain number of records, and maybe it's PHI and PII in a mix, you can start to look at all this data over the past number of years that's been collected and get a better idea of your probability of loss. Are you going to have a loss one in every 2 years? Is it once a year? Is it once every 5 years, depending on your security posture? That data is out there. And then you can start to say, how much insurance do I need? If I'm going to pay $100,000 for $20 million in limits, and I think I'm going to have a loss once every 20 years, well, does that really make sense? Maybe not. So the data is there to help model that, and I think you really need to look at the insurance premium versus the amount of limit. To put that in the context of it, to give it more of an example, is a lot of companies will say, okay, we usually insure up to 85th percentile of loss. Not talking about cyber, just traditionally. So then you want to look at your cyber posture or your security posture and look at what the claims are in your industry and because of the data that you hold and say, okay, once every 2 years, a bad day could be a $20 million loss. That's how much I should be buying, or maybe you want to insure up to 85% of that. And that starts to give you the cardinal direction of how much insurance you should buy. And then you do a deeper look at your overall posture and start to find out from the marketplace what the premiums could be.
Yeah, that makes good sense. Now, Ken, you're in the business of kind of working with clients, helping them figure out not only risk, but how to deal with it and record it and measure it, so on. When you're dealing with a client that's either about to buy or considering buying cyber insurance, and they maybe ask what sort of actions they should be taking in preparation, give us a little summary of what your advice would be, because we all know you do a better job, you're going to get a better premium because that underwriting process includes a lot of due diligence. What do you normally tell clients kind of a best practice, as they prepare to buy some policy or to begin paying on one? Are you there, Ken? Ken, are you still there? I'm not sure if Ken is on mute.
Anthony, I'm sorry. I was talking into a muted phone here.
No, please go ahead. Go ahead.
I was just saying to my muted phone, I think that one trap that folks continually fall into is one, relying on past experiences. This is what I had at my last company, or this is what my peers are doing, or something like that. As an initial starting point, rather than looking, like Anthony said, engaging what their actual risk is and what their business can tolerate. So I think that is one thing. Another area where we're seeing folks that over the years that have had a lot of problems determining what they should talk to an underwriter about, or and approaching an underwriter. I think it's having accurate data. Again, a snapshot from 6 months ago is not going to be reflective of your business risk today. So you've got to make sure that accurate that data is accurate. You've got to make sure, I think that most folks and most companies, have cybersecurity policies, but are the policies up to date? Are they reflective of the true risk? And I think understanding what your protective controls are, and then understanding what your compliance controls are too. Not every industry is the same, and not every industry is going to be find the same based on whatever data it is that you're trying to protect. So I think kind of tying all of that together. And not just relying on past experiences, to kind of move forward. Establish a clean slate, I guess is what I'm trying to say. Don't look at things as as you've always known them. You've got to take a fresh view at things.
One thing
And
that always
if I can
struck
add
me
in,
is time. Oh, go ahead, Anthony. Go ahead.
Yeah, I just want to add in because Ken does bring up a great point. I completely agree. It's you want to start with that clean slate. I guess the one thing that I've seen on the underwriting side and being on the advisory and brokerage side is, and I'll be completely honest, speaking from an ex-cyber underwriter, the underwriters overall are not nearly as technical as the security community. A lot of times there is a requirement, which I don't think is always really done on the onset and can be probably done a little bit more assertively, is educating the underwriters. So one of my hang-ups is the insurance application says, do you encrypt with a binary yes or no? Now, we all know that's difficult to answer depending on the size of your organization and what you're collecting. So there really is this education of, okay, in certain areas, yes, but just starting to talk about compensating controls or what your journey is or where you're investing in your security in the next year, I think it is really important to educate the underwriter on, well, there might not be the most favorable answers in the application. This is why you're able to sleep a little bit better at night because of the compensating controls in place.
Anthony, when you're going through that process, though, do you ever think it's a little weird that you're probably talking to an underwriter that you've never met? You don't know who they are, what they're doing. They're asking you all these questions. I know they're NDAs and other things, but that's always seemed like such an uncomfortable process where the more information you provide, in some bizarre sort of way, you're giving information away to a group that you may or may not buy from, and in some cases you just don't know who they are. Does that ever seem weird? I know in business we often have to do that, but it just always struck me as odd.
And I think there's that risk to that. I do urge people to make sure things are kept in confidence. I do urge you to avoid going down certain rabbit holes about getting too technical on configurations of certain critical databases or systems that are out there, because I agree, you're giving up your blueprints of where your vulnerabilities are, and I think there needs to be a level of confidence and agreement with the parties that you're sharing it with. But it's also required for the underwriting application. So putting other things into place like an NDA or making sure there's confidentiality provisions in that application or in the agreement with your broker or advisor, I think is very important. I think it's a fair point.
Back to your point about encrypting, the motivation, or at least the force on the CISO, would be to just say, when they said you encrypt, to just say, yeah, sure. I always wonder, if I was on the insurance side of that, and I wasn't really, like to your point, all that technical, I'd be concerned that, gosh, when you ask someone a question, they're probably going to say, yeah, my baby's beautiful. They're not going to say my baby's ugly. And maybe Ken, that's where, you guys come in. As a team helping to provide very accurate metrics, I would think that if I was an insurance company, I'd probably want to see something like that. Do you have clients that, for example, use your tool as the basis for reporting to, during this process, reporting risk metrics? Are you there, Ken? I guess Ken may hit that button.
Sorry, Ed. I thought you were talking. I thought you were talking to Anthony.
No, either one. Why don't you answer first? I'm just curious if your platform provides the basis for giving good, solid metrics-based answers to, is your baby ugly? Most babies are not, but some are. And and if you've got a dashboard you've been maintaining, that's better, I would think, than just saying, yeah, my firewalls, my architecture, we are the greatest in the world, we encrypt everything. If you say all that, that's empty answers to questionnaires, but I would think a risk dashboard that's maintained would be a superior process, probably more, would influence a better policy. Does any of that make any darn sense?
No, absolutely, and you know, and as far as you know, the whole I guess encryption controversy, right? We have a tendency to think, all right, well, you know, it doesn't from a technology perspective, it doesn't cost a whole lot, you know, from a I guess a transactional overhead to encrypt things, but you still have some heavy resistance to things with folks that don't understand where their key data is, right, or what the value of that data is. So, you know, that was one of the challenges that, you know, in putting together this platform was, you know, allowing folks the ability to kind of, you know, gauge what the value of the data is that, you know, a particular system is providing access to. So, you know, to encrypt or not to encrypt, I think, you know, goes back, you know, eons. And I think if you approach, you know, pretty much, you know, I guess any underwriter is going to say, yeah, you've encrypted it. Okay, that's better than not encrypting it. But the real value is understanding, you know, what the value of that data is that provides to the business.
Well, let's stay with you, Ken, for a minute, and let's while we're sort of on the edge of the topic of metrics, let's dig into metrics. What as you're calculating risk, as you're building a risk dashboard for a company, if you ask anyone, you stop a security person at a conference and say, what are the key risk metrics? They're going to go, patch levels, you know, do I know where my data is? How many incidents do I have per month? Things like that. Those are sort of the obvious ones. But what's been your experience there? Is there best practice emerging? I know you're part of an alliance that spent some time thinking about standardizing on risk. Talk to us a little bit. Give us a 101 on kind of risk metrics, standardization, how it might play into the insurance game.
Well, I think if you start from the risk frameworks that are out there, a lot of them aren't really even frameworks anyway. They're just basically standards. So CISOs, you know, we've been traditionally, you know, left to our own devices to kind of come up with our framework, you know, for measuring risk. But in a lot of cases, we've seen that, you know, it only measures technical risk. And so when guys, you know, they get out of business school, and these are the guys that you're dealing with on the board and executive level management, you know, they're not used to, you know, the translation of technical risk and cyber risk into, you know, business risk terms. So, you know, they understand reputational risk, they understand operational risk, they understand, you know, credit market risk, all of those areas that they learn in business school. But, you know, our job as CISOs has traditionally been to be, you know, in part a translator of technical risk into how that fits into, you know, an overall, I guess, you know, a holistic risk management process. Now, the question comes there, how do we do that? You know, and as far as metrics go, you don't want to go in with minutia. If you go in armed to a board meeting with minutia, you know, patch levels, vulnerabilities are down, you know, they're going to like, what does that mean? What does that mean to us financially, right? And I think, you know, quantifying that and qualifying that has been a real headache over the years. So, you know, you've got to break it down, I think, in you know, our I guess, you know, risk metrics. We use a 3-tier model, all right? You've got the minutia down on the bottom, which is number of events, number of this, number of that, patch levels, whatever the case may be. But then you also have to be able to translate that on a second level to make, you know, managerial issues and a little bit more palatable. You know, am I staffed adequately? You know, do I need to staff up, staff down, temporary contract help, non-temporary contract help, you know, FTE, whatever the case may be. Those middle-level management decisions that, you know, CISOs and other managers have to deal with. But from the top-tier perspective, which is where, you know, the 3 tiers of metrics are concerned, you've got the executive-level questions that you need to answer. You know, are we secure enough for our business? How are we in relation to our competitors? Are we investing properly? Are we investing enough? Those are the questions that you're going to get asked by the board. And if you've got no way to translate that minutia into something that's, you know, understandable, as well as something that you can back up with, you know, with actual data, should they want to see it, because, you know, face it, Ed, we've got guys on the board now like you, right, that understand the minutia, understand the data, and more folks are joining boards that, you know, that they understand what the data and the value of the data provides. So you've got to have that, you know, as a way of explaining things should they want to see it.
You know, it would seem like in the most logical case, and Anthony, I'm curious what you think about this. In a logical case, you'd say you do all the things Ken said. You identify at the appropriate levels a risk posture. You make it so that everybody understands the key issues. And then someone somewhere just looks at this and says, hey, we've got a bit too much risk over here in this area. We probably should buy an insurance policy because, and Anthony, tell me if this is dumb, in theory, if you were doing everything you could, maybe you wouldn't need an insurance policy. I mean, I think you said it earlier that you'll never get the risk down to zero, but is it just impossible to imagine that this would become this deterministic process where I have numerical quantifications of risk in different areas, I establish thresholds, I'm below some threshold, and I use the insurance to push me over the level to where I'm comfortable? Is that just way too gearhead and way too perfect to imagine? I'm guessing that it's a more imperfect process than that. But what are your thoughts on sort of the role of quantified metrics and having some trigger or threshold be established when you go buy the policy? Does it ever work like that?
I think there is some valid points to that. I think that is starting to happen a little bit more. I mean, we're big fans of that, quantifying it. There needs to be a risk tolerance. What's your risk threshold? I mean, I'll give a quick example. We were just with a very large asset management company, and we got into this conversation, and we started to talk about data classification, and everything is mapped in 95% of the organization. Okay, so what's the 5% that's not mapped? Well, there's unstructured data sitting in some files on one server, and now we know that it contains PII, where how many records are there, and we talked about the number. And at the end of the day, the financial impact, the dollars and cents of if that got lost, we kind of worked through it and quantified it, was under their operational risk threshold. They could sustain that. It would not be material to the organization. It wouldn't be a blip at all. But then it just led into the next conversation of, okay, there's the financial threshold. What about the regulatory and the reputational threshold? You're going to need to notify. It's going to probably be in the press, even though it's not big. What's the threshold there? Is it something where those costs now are going to exponentially go up and you need insurance? And it ended up, no, you don't. So I think there's that reality of you can retain some risk if you're doing the right things. Sometimes money's better funneled into security than it is to buy insurance. Other times, if you're not completely 100%, just like you might have that dead tree leaning over your roof, but you're not going to take the tree down, you're buying your homeowner's insurance because it's much, much cheaper because it'll kick in if, God forbid, something happens. It's the same type of approach.
Do insurance policies in cyber generally include coverage for paying fines or, some sort of damages as a result of a breach, like a fine to a federal agency or something like that? Do they typically cover that sort of thing, or is that considered out of scope most of the time?
Depending on the geography. So this is a hot area right now in cyber insurance that should probably be talked about for a minute. In the U.S., you see HIPAA fines typically covered. You see injunctions and penalties levied by state AGs typically covered. It's kind of wherever fines and penalties can be insured by local jurisdiction, it's then allowable in cyber. In the U.S., in North America, we see it covered a lot generally. Going outside of that, there's new regulations that have not been tested. The insurability of fines and penalties, if we're talking about GDPR, has not been tested. I'd say half of the European Union members will not cover fines and penalties through insurance because they're meant to be punitive. The other half are pretty much silent on it, so it's to be determined. So when you get global in scope, it gets a little bit dicey. I think the key there is the insurance is covering the incident response costs and any kind of liabilities, but never hang your hat on insurance for fines and penalties.
Because the GDPR is meaningful in terms of the size of fines. I would think that moving forward, that's probably a pretty good business area because once you have a little body of understanding of what people are actually being fined, I don't think we know yet, but once we do, that'd be an example of something that I would be wanting to buy some insurance for, simply because that can be a very subjective determination as to whether you've violated some GDP article and you've got a customer, raising hell with you. I would think that would be big. Ken, in your practice, do people bring up international frameworks more frequently, like the GDPR?
Oh, absolutely. I mean, pretty recently I was a CSO for an international company. We had offices in 27 countries. So, that's a lot of cat herding that you've got to do from the risk perspective. To Anthony's point, a lot of it has yet to kind of shake out just yet. What we've done, I think, over the years, traditionally, has been we've always played to the strongest applicable baseline, right? So tighten it down until it squeaks, and then back it off a half, and then most folks are thinking, well, okay, we're covered. We're as we say, secure enough for our business, right? But as things change, and as more more avenues to get fined are introduced into things. Some of them are pretty much, knee-jerk reactions to one particular event, as we've seen with a lot of legislation. But I think others are completely justified in moving in the right direction, as, I would say with GDPR. But you can't try and make one size fits all, from the risk perspective. You have to, it's okay to have a baseline. But you've got to be able to kind of gauge that. In particular, in my case, it was what is the value of the business at that particular location? What are they embodied by, as far as legislation and fines, and what are they on the hook in particular? And you've got to be able to gauge that. You've got to be able to put that into a total formula. That's just going to make your cyber insurance program just much more effective when you've got that accurate data. You've got it, and it's palatable to that particular business unit, right?
Mm-hmm, mm-hmm, mm-hmm. Now we've got a couple of questions that are popping in here. Let me pull one off the list here. So this one, Ken, I'm going to assume this will be for both you guys. I'll start, Anthony, with you, and then Ken, you might have an opinion. It's about nation state, and the question is, should a cyber insurance policy cover an attack from a nation state military? That's an interesting question. I'm not sure I know the answer to that. What do you think, Anthony? You first.
Yeah, sure. So attacks from nation states, my answer is yes, it should be covered under the cyber insurance policy. I would urge everyone who buys cyber insurance to carefully, again, read the policy. There are war exclusions, and those war exclusions just don't exclude war. It says acts of hostile enemies or nation states, and it can be pretty encompassing. And there's a way you're able to get what they call a carve back from the insurance company to say, however, this exclusion will not apply to malicious attacks or incidents. The reason for that exclusion, it exists in almost all insurance policies because the insurance community, the hundreds and hundreds of billion-dollar insurance marketplace out there, does not want to be on the hook for a war, and all of a sudden every single policy is paying for all different perils under wars that are out there. But I think the intent, if it's a nation state attacking a company, it should be covered under cyber insurance policy. Make sure you have the language. And the one thing I'll say is attribution is really key in the benefit of the policyholder, because most of these cyber insurance policies are what they call duty to defend. You start defending the issue, you start paying for the claim until you can deem it otherwise. So attribution and saying it's definitively a nation state attacking you, that's going to take a lot of proof, and that burden is on the insurance company, and that insurance policy should be paying for all that money, and there should not be a payback period. It should just maybe be cut off if it's going to be otherwise excluded for some reason, but otherwise you should be paid for that attack for as long as possible, if not the whole thing.
Mm-hmm. Ken, any thoughts on that, on nation state?
Well, risk is risk, be it nation state or otherwise, and I think that what Anthony said is spot on. And looking at what your particular exclusions are. But I think one thing to add to that would be to while you're looking at your exclusions, look at who's going to bear the burden of proof financially, in far as making that proof, right? Because there may be a clause within your policy. Let's say it takes you $1 million in costs, in man hours to actually prove attribution. Who's going to absorb that? Because if you've got a total loss of like $1.1 million and you're spending $250,000 on your deductible and you're spending $1 million in costs just to prove attribution, it's probably not going to be worth your time, right? So I would say look at those as well.
Hard to do.
And that brings up a great point. And if you don't mind, the one thing, too, on Ken's point he brings up that we haven't talked about, I think going back to a bad cyber policy versus a good one, a lot of times these insurance companies provide their panel of forensics and legal counsel and notification firms and credit monitoring, which some companies actually buy the cyber insurance policy because they get access to that. Many companies, though, already have their preferred companies that they're working with and their partners. So you also need to really watch that insurance policy and make sure you don't start dialing up your vendors and responding to an incident when your insurance company might not even cover those costs. You should pre-negotiate those things and make sure it's in your policy so you can work together.
I see a really interesting question here. I'm going to try and paraphrase. In a minute, though, after we do this one, Ken and Anthony, I'll ask you guys to provide a closing sort of comment, just to kind of bring us home with a final thought. But this is an interesting one. It has to do with written in quotes pre-existing conditions, and I think I know what you're talking about here. The idea is that sometimes policies reference a pre-existing vulnerability or problem that has to be disclosed. Well, I'll start with you, Anthony. That's a weird one, right? Because if you're running an operating system from a commercial vendor, that thing's probably loaded with vulnerabilities that are existing before you're done. How does that work? Does it have to be some blatant thing that you disclose, or do little nits have to be disclosed, or every little CVE that hasn't been covered? How in the devil do you guys deal with that problem?
Yeah, I would advise steer clear of policies that have that language. The underwriter may ask questions about patching cadence, anything that's been in the news recently. Have you upgraded or patched your systems? You really need to steer clear for those there was an old cyber insurance policy years ago that had an exclusion around failing to upgrade your system to cybersecurity norms. What in the world does that mean? It's just, you really need to watch that language. So any pre-existing conditions, steer clear from. Just fill out the application, disclose your best ability. The underwriter needs to have a comfort, and then you want the broadest coverage possible.
Well, that's good. You probably saved a lot of people some trouble there. Ken, I'm going to ask you. Go ahead, Ken.
I was just going to add to that. I was going to say that, in most cases, if you can demonstrate, proper process and policy around those things, most folks are going to be good with that. Do you have a process for identifying, what these, latest and greatest vulnerabilities are? How does it relate in your enterprise? How do you value and how do you gauge the risk to that, within your enterprise? If you can show proper process and policy around that, they're usually going to be, you're usually not going to be on the hook for minutia, for maybe something that might slip by that that you might not know about, because you can't know all things, right?
Yeah, it does make sense. So, Anthony, why don't you give us a couple of minutes, your final thoughts, anything maybe we haven't covered, or any parting advice, and then we'll turn it over to Ken to close us out as well. But anything to close with, Anthony?
Sure. Look, the cyber insurance, it depends on where your company is and your risk tolerance. Like I said, some companies buy it for the incident response because the insurance company has those vetted vendors that can really help and do it at a low cost. I would add one thing that we haven't talked about is we do see many organizations buying cyber insurance because of their vendor risk, and they know because of the data that the vendor holds, the policyholder will be on the hook at the end of the day, so they buy insurance for that. From the insurance claims that we see, it's typically around $40,000 at an average incident cost. If there ends up being liability or a settlement, it bumps it up to roughly $2 million. That's across the globe of companies of all sizes, so it's a really large range, and that's just the average. But look, again, it's really setting the risk tolerance and what's your posture, and should you funnel money back into controls, or are you afraid of that bad day and you need some balance sheet protection? So there's tools, and the data is out there which can help.
I love your point about third party. It's like, I'm going to use you as my third party, but I have to buy insurance to deal with you.
It's the reality. I know.
A lot of confidence there. Hey, Ken, why don't you close us out? Any final thoughts that you'd like to share on this topic?
Yeah, I think, as far as my Jerry Springer final thought on this is just understand what your holistic risk is. Don't just go into it blindly, from a tactical perspective. I mean a lot of us, came up from the tactical ranks and we understand that very well, but it's understanding what the holistic risk is and what you're going to be on the hook for. If you don't understand what you're going to be on the hook for, there's no way that you can effectively even begin to negotiate any type of cyber insurance environment. So I would say don't focus on too much on the minutia, but focus a little bit more moving forward on how that minutia relates into your overall business risk posture, because that's what you're going to be on the hook for at the end of the day.
That sounds like excellent advice. So, listen, on behalf of my good friends Anthony and Ken, I want to thank you all for participating. And those of you listening in, I appreciate you listening to our content. I hope it was useful and enjoyable. And Mike, I'm going to turn it back to you to close us out.
Thank you, Ed. In closing, I want to thank our panel for a very intellectually engaging and informative discussion on the topics of cyber insurance and cyber risk governance for the enterprise. I'd like to thank Ed Amoroso of Tag Cyber for his leadership in this conversation, Anthony Dagostino of Willis Towers Watson, and Ken Pfeil, formerly CISO himself and now Chief Security Architect for Tech Democracy. I'd like to encourage you to share this broadcast with others that you think might be interested. And finally, today's webinar was made possible by Tech Democracy, a leading global consultancy in IT, identity, access management, and cybersecurity consulting. Tech Democracy's latest innovation is in Licta, a risk management platform that distills the complexity of cybersecurity technology into risk scores and alerts that can be monitored, managed, and communicated to senior management and boards of directors in metrics and language they can understand and evaluate. Thank you for your attendance, and goodbye.